Hi, I'm Scott from Precision Wealth Management. Today I want to run through a small business sale case study. Now I've got two scenarios here. So scenario one, there's one business owner, or I guess they're a couple, and they own a family business that have done so for the last 20 years. They're now 60 years old and they're selling their business for retirement, and they sold it for $800,000. Scenario two is a business owned by 5 separate individuals. In this scenario, the $800,000 sale is just one owner's portion of the sale. And again, they're selling it for retirement. However, it's just one portion of the sale. The small business CGT concessions isn't available to everyone leading into retirement. So in scenario one, because they've satisfied the criteria for the small business CGT concessions, they are able to sell that property CGT free. And so effectively they can take it into their bank account or put it in super or whatever they would like to do within the caps. They can do so. And there's no, significant tax implications there. But for scenario two, the owner that sold their proportion for $800,000, he doesn't satisfy the small business CGT concessions. And so he has to do a little bit more planning in order to, reduce the amount of tax he has to pay on that $800,000 business sale. Now, for someone in this scenario, it could be appropriate to set up what's called a bucket company and put the business sale proceeds in the bucket company, because if he was to add that whole business sale onto his taxable income for a financial year, he would pay a significant amount of tax. So by doing this, you keep it within the company tax environment. So it's still taxed at the company tax rate. So from here, what he might do in the first financial year that the business sale took place, he might take a large drawing into his bank account and make a large superannuation contribution. And so by doing so, he's effectively putting that into super where it's taxed at 15% rather than his marginal tax rate, which could be up to 47%. He can utilise in this first financial year, or he may be able to utilise what's called the carry forward concessional contribution cap. So he could have available from the last 5 financial years unused concessional contributions that he can then, claim a larger tax deduction in this first financial year. Now, if he uses up all this cap in this first financial year, he doesn't have any available carry forward in future financial years. He just has the general concessional contribution cap. And so each financial year, he would take drawings into his bank account over time until eventually all the funds have been taken out of the bucket company. Over these years as well, he would be making concessional superannuation contributions up to the general cap, which at the moment is $30,000 a year. Now, the amount he takes and the amount of tax he pays, again, is dependent on the individual's circumstances. But after all the funds have been taken out of the bucket company, then the bucket company can be wound up. And what you get is 2 scenarios with the same size business sale proceeds and completely different, financial implications and tax consequences. So in this scenario, although he's had to pay administration and accounting fees over a significant period of time, the amount of tax that he would have paid would have largely outweighed any costs of doing this over time. So as you can see, each business owner's circumstances are different to one another. If you'd like some tailored specific advice on your personal situation, come see us at Precision Wealth Management.